Hi everyone, we are live here today at the Business Exit Summit, and I'm delighted to be sitting with Daniel Erez, partner at Pindara Partners. Daniel, I have to say I love the name Pindara. It's an Aboriginal word meaning high place, and your whole philosophy is about seeing things differently from that elated perspective. So before we dive into business exits and scaling, can you tell us how did you end up in this space? Like what drew you to property financing?
Yeah, thanks, Rhythm. Great to be here. I guess for me, it was a natural evolution, starting in the real estate industry, first in general agency, and then through that process into project marketing, and then from project marketing into development. And then from development, it was just a logical and natural evolution into real estate investment, real estate finance around 2014, 2015.
Oh, right. Very interesting. Now, we're here today at the Business Exit Summit, and you recently had a panel as well. So can you share some key highlights from your panel discussion with the audience today?
Sure. Well, I think some of the highlights have been on the panel with the other participants, in particular Ken and Rob, who gave some great insights. In particular, Ken's the main takeaway was that your baby's ugly. I think that's a great one to take into account. Talking, of course, in context of one's business and not falling in love with every aspect of it, not being blinded by it, and actually looking objectively at the business through the lens of a potential buyer. So I personally found that quite useful. And Rob's journey as well, having sold two businesses in particular in the United States, I found quite interesting too. So clearly a lot of IP here today, and I'm sure all of your participants are going to get a lot out of it.
Yeah, absolutely. Actually, funny enough, this is actually something I'd mentioned to one of the speakers that I had a conversation with, that most founders tend to see their business as like their baby. So sometimes it's difficult for them to take the feedback as well. So like, especially when you're talking about exiting their business, it's not a conversation they want to have. They don't want to get ready. And most of the advice that's coming from the speakers is to get ready for an exit. Like, do you feel that founders find the conversation around business, like their exit strategy, something that they don't want to have and they're not as ready as they should be?
Well, I don't think it's necessarily founders don't want to have the conversation. I think most founders do want to have the conversation. I think that if you're saying, rightly, I think a lot of founders, they put a lot of energy, mental, emotional energy into building this business. And clearly, as human beings, we, come with a lot of emotion, and that gets attached to that energy and that effort. So it's natural that people are going to feel that way. I think, the key takeaways from, certainly Ken was that, get professional advice, pay for the best advice you can get, find out who the advisors are of the firms that are acting for, the types of firms that your business could look like one day, and pay for that advice and really get an objective view on it, and prepare yourself for, a potential exit. Whether you actually do or not is something different altogether, but at least be prepared if it does happen.
Yeah, absolutely. Well said. Now, for you, what are those green flags that make you think that, this business is going to have options when it comes to time of selling?
Well, look, firstly, I'm no business expert. I'm not a M&A executive or investment banker. All I have is my own experience. And even now, having started Pindara Partners, which is like our version 2.0 of what was New Grand Capital Partners, people asking me now, are you going to build it to sell it again? And honestly, sitting here today, the objective is not to build a business to sell it. The objective is to just build a great business. And what that means for us is making great investments, building a great track record, returning, making returns for our investors. And we feel that if we keep the main thing, that will in itself become a valuable business. And if someone wants to buy it and we feel like selling it, well, that's great, but that's certainly not the objective. Right. The objective is to build a great business.
Yeah, absolutely. Very well said. Now, one thing that I noticed about Pindara is that you guys co-invest alongside with your clients. So how does that change the dynamic of the relationship? So I imagine then, when you've got the skin in the game, conversations, do they become difficult or is it easy to navigate?
Well, when we started Pindara, we started it because we wanted to invest our own capital into transactions that we had a level of experience and knowledge in, and that was real estate credit. And so we started purely from the basis of investing our own money. So we didn't start to take on third-party capital. Over time, since starting 2 years ago, we're now starting to take on some third-party capital. But I think, again, counterintuitively, because we're focused on investing our own money, investors find that incredibly attractive because they want to invest alongside people that are putting material amounts of capital and having been high conviction on the ideas that they're investing in. So for that reason, the conversations aren't difficult at all because, it's kind of what's good for me is good for you type of mentality.
Correct. Yeah, definitely. Now, Daniel, looking ahead, we are in interesting times economically. So what's your outlook for the property and exit space for the next couple of years?
I have absolutely no idea. No, we try not to get too... make big predictions or think too far into the future because the reality is no one knows what's going to happen. We try and stay focused on what's immediately in front of us and perhaps, over the next, 3 to 6 months based on what we're seeing in terms of trends, in terms of transactions, in terms of prices being paid and that type of thing. I think what we are seeing is that there's early signs of recovery in the real estate market. This is the commercial real estate market. The residential market remains quite buoyant. The interest rate cuts that we've seen here in Australia have thankfully not done too much to overheat the residential market, and we know that's a genuine concern of the RBA and should be a concern for all of us. But certainly in the commercial real estate market, we're starting to see some early signs of recovery and an increasing level of activity and transaction volume, which is really positive for the market as a whole.
Absolutely. Now, Daniel, before we wrap up our interview today, I would love to ask you, how's your experience been being here today? I mean, you did share some key takeaways from your panel, but is there anything else you would like to share with our audience?
Your baby is ugly. No, I can't take any credit. That's Ken speaking, and it's a great piece of advice. There's really not much else. I mean, it's incredibly humbling to sit next to people like Ken and Rob who have done it many times over. I still feel woefully underprepared to be here, having only done it once or twice. But I think that's great advice from people that are out there doing it every day. And so everything that they share, just watch their session, and you'll be fine.
Well, hopefully, I'm sure that in a few years, you will have just as much expertise as them, and you'll be giving just as much advice as they are giving to the audience today.
Maybe. Thanks for your time.
Wonderful.
Rhythm.
Thank you, Daniel. Thank you to our viewers for joining in. I look forward to seeing you all in my next interview. Thank you.